Give us some of the details here. What exactly is the SEC doing? What are they looking at?
Right. So the stock market and actually all markets have really evolved dramatically in the past 5 to 10 years with the growth of computer trading and computer power used by firms that can move very quickly in and out of securities. Basically, what you're seeing the SEC doing, and also the Commodity Futures Trading Commission, is playing catch up, trying to figure out what's going on and see if there are any games being played. Specifically, what we're writing about today is whether there are some relationships between exchanges and high-frequency traders that give the high-frequency traders an advantage over other investors. So right now, this is basically a review. It's not an official investigation, but it could turn into something very serious because it is the enforcement division of the SEC.
Scott, games being played on Wall Street, I think that we have to question that, first of all. In a more serious tone. It seems like it's really a fact-finding kind of aspect, so there really isn't any subpoenas or anything like that going out at this point.
Right. Well, there could be subpoenas. We're looking into that. But right now, from what I can tell, and Gene Eaglesham, who also wrote the story with me, is they're asking for information from these firms about their trading activities and about their communications with the exchanges to see if they're getting any information about the way that the exchanges work that other investors don't have. And you have to think about the relationship between exchanges and these high-frequency traders. The exchanges really depend on them to provide the order flow that helps them keep the gears running. If they have a lot of flow, they can get more flow. It's kind of like this fundamental rule in markets is liquidity breeds more liquidity. These guys bring oceans of liquidity. So the concern is that maybe they're getting some advantages and they might know certain things about how the exchanges work, the plumbing, the interior structure of the computer systems.
You know, it's interesting. One of the exchanges you mentioned is one that I bet a lot of people aren't really even aware of. Talking about BATS Trading. This company has really come out of nowhere and has become the third largest exchange. They actually had their IPO there. They went public, priced it last night, trading today. How much of, I know they didn't want to comment for the story. How much of their growth has been tied into this trend?
Right. Well, BATS is directly tied into the growth of high-frequency trading. It was launched in 2005 by Dave Cummings, who is a pioneer in high-frequency trading. He launched one of the first real big high-frequency trading operations in '99 called TradeBot. So in 2005, there were some mergers between electronic exchanges, or ECNs as they're known, electronic communication networks, with the big exchanges. So Archipelago merged with the New York Stock Exchange, and Instinet merged with NASDAQ. Dave Cummings felt like he was losing his favorite venues to the big boys who he wanted to compete with. So he launched BATS. BATS was just basically a computerized trading matching engine. And it grew rapidly, in part because TradeBot was using it, and another big trading firm that the SEC is apparently looking at now, GetGo, were both investors in BATS. So they helped BATS grow a lot. They provided a lot of liquidity. It's very fast and efficient exchange, and the high-frequency guys like it a lot. So there's this relationship between the high-frequency firms and BATS, as well as Direct Edge, which is another exchange that people probably haven't heard much of. It's almost as big as BATS, and it's favored by high-speed firms, such as Citadel, which is an investor.
So Scott, I mean, the question is whether these firms have an unfair advantage or an advantage. Seems obvious to me they have some kind of advantage. But the real question, I guess, for the SEC has to be, are they doing something wrong? Are they doing something that isn't in the best interest of the general shareholders, in the interest of the markets? How do you determine that?
Right. Well, that's what they're looking at, and nobody really knows right now what they're going to find. It's perfectly reasonable to think that some firms should have an advantage because they're providing liquidity to the markets. So market makers at exchanges are given advantages so that they can trade as rapidly as possible with less risk. But on the other side of that is they have obligations. to trade through markets that are volatile and
Right.
provide liquidity and maintain even and orderly markets.
Yeah.
That's the concern, is that these firms may not be doing that all the time, and that's what happened on the flash crashes. Many of them pulled the plug because things got too volatile and they didn't maintain orderly markets. So it's a trade-off.
All right, we got to leave it there. Scott, thank you very much for coming on. I'll talk to you soon.
My pleasure.